What if I told you that you could unlock tens of thousands of dollars from your CPF retirement account without selling your home or giving up ownership? It sounds like a no-brainer, right? Extra money in your pocket while you continue living in the same house. But here's the catch. While pledging your property with CPF can give you that flexibility, it's not all upside. There are trade-offs, and if you are not careful, it could leave you short of money later on in life. So in this video, let's break down exactly what property pledging is, how it works, the benefits, the downsides, and whether it's something you should actually do. Hi, I'm Fer from Dollar Bureau, a personal finance platform that talks about insurance, investments, and financial planning. Alright, so let's kick things off with the basics. What is property pledging? Think of it this way. When you reach 55, CPF says you need to set aside a certain sum for retirement, the FRS or the BRS. Only after you set aside, you can start withdrawing the rest. Now, not everyone has enough in CPF to meet those sums. So instead of topping it all up in cash, CPF lets you pledge part of your property's value. It's like telling CPF, hey, I may not have the cash right now, but if I ever sell my house, you'll get this portion back. The important part, you don't lose your home, you still live in it, and you still own it. CPF just places a kind of safety net around it to make sure that you have enough for retirement. Okay, that's the idea in theory, but let's look at how it actually plays out in practice. Let's use an example. Say the full retirement sum is $213,000, you can pledge up to half of that, about $106.5K. Once you pledge, CPF says you've met the requirement, and that gives you the green light to withdraw more of your retirement account savings at 55. But there's a condition. CPF will place a legal charge on your property. That means if you ever sell it, the pledged amount plus interest must go back into your CPF first. Anything left after that is yours to keep. So the way to look at it is this. Pledging doesn't mean you're giving away your home, it just means that CPF has the first claim to a portion of its value if you decide to sell. Now, why would anyone want to pledge their property? The big draw is flexibility. Instead of having all your money locked up in CPF until your monthly payout kicks in, pledging gives you the chance to access more of it at 55. For some people, that lump sum can be a huge relief, whether it's paying for healthcare, renovating the home, investing it, or even having cash on hand just for a peace of mind. At the same time, whatever remains in your CPF retirement account still grows at 4% a year, plus that extra 1% on the first $60,000. That's guaranteed risk-free growth. So even while you withdraw, your remaining money keeps working for you. In short, you keep your house, you unlock cash, and you can still earn interest on what's left in CPF. Sounds good so far, right? Let's go a bit deeper into the specific benefits people look out for. So let's connect this to everyday life. Maybe you're 55 and still helping a child through university. Or maybe you've got parents' medical bills piling up. Having extra cash on hand could help you cover these costs without dipping into personal savings or taking on debt. That's one of the clearest benefits. It gives you control over when and how you use your money rather than being locked into CPF system. And because you retain ownership of your home, you don't have to move out or downsize just to access the value in your property. Of course, this leads to the next big question: how much can you actually pledge? The short answer is up to 50% of the full retirement sum. But the reality depends on your situation. If you co-own a property, only your share counts. If the lease is too short or if there's a heavy loan still on it, that also limits what you can pledge. For HDB flats, you'll need at least 30 years left on the lease. For private properties, the lease has to stretch until you're at least 95. So before even thinking about pledging, check your lease and any outstanding loans. Otherwise, you might not qualify in the first place. Now, let's tackle another common question. What happens if you want to sell your property later on? Can you still sell your property? Yes, you can. Pledging doesn't tie your hands, but here's the part that people often forget. When you sell, the pledged amount plus interest goes back into CPF first. So while you still keep the rest of the sale proceeds, you need to plan for that refund in your long-term financial strategy, which is something many forget. I've talked about this, accrued interest that you'll need to pay back in another video, so be sure to check it out. So far, we've looked at the positives, but let's be honest, there are always downsides that you really need to know about. Now, here's where the trade-offs come in. The biggest one is your CPF life payouts. If you set aside the full retirement sum, your monthly payout might be around 1.7K. But if you only meet the basic retirement sum, your payout drops to about $900. So even though you technically meet the FRS, the amount you get from CPF Life is based on how much is left in your retirement account, which is the BRS. Trust me, I experienced this many years back when a financial advisor recommended my mother to pledge her property without clearly highlighting this until I checked with CPF. And here's the issue. Research shows that retirees in Singapore need about 1.5k a month for basic living. That means if you go the BRS route, you're looking at a shortfall of over $500 a month. Of course, you could use the money you withdrew to cover that gap. But let's do some calculations. If you withdrew 106.5k at 55 and spent $562 a month to cover the shortfall, the money would only last about 16 years. By 71, it's all gone, and with the life expectancy age of Singapore being 83, that's another 12 months surviving on just $900 a month, and that's without considering inflation or rising medical costs. So while pledging feels like extra freedom at 55, it can make your later years tighter. If you're gonna withdraw it just to pay yourself the difference, you're better off leaving the money in your CPF. At this point, you might be thinking, what if I invest the withdrawn money instead? Let's talk about that. Some people think that no problem, I'll just invest it. So I did some calculations and let me show you how much you'll need to get in returns to even beat just leaving it in the CPF RA. If you maintain the FRS of $213,000, the CPF Life Standard Payout Plan provides a payout of about 1.7k for life. This equates to a 9.75% withdrawal rate per year, a guaranteed income that continues for as long as you live. By pledging your property and withdrawing half of the FRS, you're left with the BRS, which means your monthly payout drops to about $930. While this still represents a generous 10.5% withdrawal rate, it's worth noting that your remaining CPF RA funds continue to grow at a risk-free 4% annually. This means that you would need your investments to at least generate returns of 10.5% withdrawal rate to match your CPF Life payouts, plus a 4% annual growth to account for the risk-free returns you're forfeiting in CPF RA. This totals a required return of 14.5% annually, which is challenging to achieve consistently even with high-performing assets like the S&P 500. And let's be real, even the best investors struggle to beat that safely. And in market downturns, you could easily just end worse off. So unless you've got other strong sources of retirement income or are an experienced investor with a high tolerance for risk, which at 55 and nearing retirement, withdrawing to invest is a gamble that may not be worth it. By the way, if you want to learn more about how the CPF retirement account actually works and why that 4% return is so powerful, I've made a full video on it. I'll leave the link on the screen and in the description below. But hey, let's say you've weighed the pros and cons and you still want to go ahead. How exactly do you pledge your property? If you're still interested, here's how it works in practice. You'll need to book an appointment with CPF at one of their service centers. For HDB owners, bring your co-owner consent form, property details, and any loan statements. For private property owners, you'll also need your bank's consent if there's still a mortgage, plus NRIC copies of all owners. Once CPF approves everything, they'll place a legal charge on your property, and after that, you'll be able to withdraw all the additional funds. It's not a complicated process, but it does take paperwork and some coordination if you got co-owners or loans. Before we wrap up, let's clear up a couple of common questions people usually ask. So, I get two questions a lot. First, can you pledge a property with a loan? Yes, you can, but your lender has to agree, and when you sell, the loan gets cleared before CPF takes back the pledged amount. Second, do you lose your house? No, you don't. You keep full ownership and stay living in it. CPF only steps in when you sell or transfer the property. With that out of the way, let's tie everything together. So, should you pledge your property with CPF? It really depends on your goals. If you need extra cash at 55 and want flexibility without moving out of your home, pledging can be a helpful option. But if you're worried about having smaller CPF Life payouts, outliving your savings, or not being able to invest effectively, then it may not be the right move. At the end of the day, this isn't a one-size-fits-all answer. It's about your retirement lifestyle, your needs, and your appetite for risk. If you are unsure, my advice is simple: don't guess. Speak to a trusted financial advisor who can walk you through your situation. I'll leave a link in the description if you'd like to connect with one of our partners, and the best part, it's completely free. If you found this video helpful, don't forget to like, share, and subscribe for more practical financial tips. Thanks for watching. I'll see you in the next video.